Welcome to this video. My name is Mac, and in this video I'm going to walk you through the complete trading system that I use to trade professional prop firm accounts, all condensed into a free mini course. So by the end of this video, you'll have a clear understanding of how I read the market, what I look for before entering a trade, and how it all comes together into one repeatable, rules-based system. Now I want to be upfront about what this video is and what it is not. So this is not a motivational video. It is not a get-rich-quick pitch, okay? And it is not a surface level overview of basic trading concepts that you've already seen 100 times. This is a genuine breakdown of the exact system I actively trade. The same system I have refined over nearly 7 years of consistent trading. Everything I cover today is part of the full MacFx Academy course. This video gives you the foundation and the overview. The course is where you get the complete system in full detail, the specific rules, the in-depth chart examples, and everything you need to actually execute it. But this course is just the starting point. So once you have completed it, you get access to the MacFx Academy network, which is a private trading community where you can trade alongside me and other serious traders who have put in their work to learn the system and are applying it in the live markets every day. But more on all that at the end. So for now, let's get straight into it, starting with one of the most important things that traders never think about before they even look at a chart. Before we get into any technical analysis, you need to understand one thing. Who is actually responsible for moving price up and down in the market? Because it is certainly not you and me. It is not retail traders as a whole. It is the big banks. And you need to understand how they operate before any of the technical concepts I'm about to show you will truly make sense. Because the entire system is built around one goal: identifying what the big banks are doing and trading alongside them. When I say the big banks control price, what do I mean exactly? Well, I'm talking about the interbank market. The interbank market is the wholesale layer of Forex, where the world's largest financial institutions trade directly with each other. We're talking about transaction sizes that regularly exceed millions of dollars per trade. And a handful of these institutions collectively control the majority of global Forex volume. These players are not gambling, they are the house. But here is the problem that they face. They have too much money. If you want to buy $1,000 worth of Euro USD, you click a button and you are filled instantly. But if a big bank wants to buy $100 million worth of Euro USD, they cannot just click buy. There simply is not enough currency available at that price to fill an order of that size. They need liquidity. In plain terms, they need someone else to take the other side of the trade. For them to buy, they need a mass of sellers. And for them to sell, they need a mass of buyers. And here is what makes this particularly one-sided. The banks have access to positioning data. They have a clear picture of where retail orders are clustered, where their stop losses are sitting, where their pending orders are, and how large those positions are. So how do we compete? Well, we find new ways to trade. We stop using the same generic retail trader concepts that the big banks like to exploit. Instead, we learn how to read the big banks' footprints because they cannot hide their activity entirely, and we trade alongside them rather than against them. And that is the entire premise of the system I am about to walk you through. So there are only really 3 things that actually matter in trading, namely money management, trading psychology, and trade entries, which in my system is purely based on technical analysis. Now, before we get into the technical side, I want to cover 2 things quickly: money management and psychology. I say quickly, not because they are unimportant. They are actually the most important things in trading. But I want to spend the majority of this video on the technical concepts. So I'm going to give you the core principles and move on. Money management. Now, most traders skip over this or treat it as an afterthought. Now, that is a huge mistake. In my opinion, money management is the single most important thing in trading. More important than any technical concept I'm going to show you today. Here is the principle I trade by. In this game, you win by not losing. I am a defensive trader. I prioritize protecting my capital above everything else. Because if you can keep your losses small and controlled, the winning trades take care of themselves. The other thing money management does and this is something that most traders never think about, is it protects you during losing streaks. And losing streaks will happen. It doesn't matter how good your system is, you will take 3, 4, even 5 losses in a row at some point. And that is just the reality of trading probabilities. But here is the thing. That does not mean your system is broken. It does not mean you need to go and find a new strategy. If you have backtested properly and you have data proving your system works over a large sample of trades, then a run of losses is just part of the process. The next 3 to 5 trades might all be winners, and that is just how probabilities work over time. But money management is what keeps you in the game during those inevitable losing streaks. Even with a win rate of 50%, which is actually a very solid win rate, and you can make serious money with it, you need to make sure that when those losses come, they are not wiping out your account. You keep your risk controlled, you keep trading your system, and you let the probabilities do the rest. That is the foundation. Trading psychology. Now, I'm no psychologist. I'm just someone who has been through it. And the honest truth is that psychology was the hardest part of this journey for me. Harder than learning the technical side, harder than passing prop firm challenges, which I think is the case for most traders. Now, here is what I know. Human emotions were not built for trading. Fear makes you exit winning trades too early. Greed makes you take trades that do not meet your rules. Excitement means you're probably gambling. And these responses are all natural. But they have no place in trading. The fix is not a mindset hack. It is data. Once you have backtested your system, journaled your trades, and reviewed your results, you have hard evidence that your system works over a series of trades. That evidence is what replaces emotion. You are no longer afraid to take a trade after 3 losses because you've already seen in your own data that you can take 4 or 5 consecutive losses, follow your rules, and still come out profitable over the series. Start thinking like a casino. The casino does not care if you win 1 hand of blackjack. They know that over 1,000 of hands, the odds are in their favor. You are the house. Your system is your house edge. 1 losing trade means nothing in a series of 1,000. Now let us get into the technical side, because this is where the majority of your time today is going to be spent and where the real value of this video is. I'm a technical trader. Every single one of my trade entries is based on technical concepts. Now at a surface level, these are the concepts I use. Now a lot of these may look familiar. Things like market structure, supply and demand, and liquidity. But what separates my system from any other generic supply and demand system is volume. Volume adds a layer of confidence to my trading that has taken everything to a completely different level. Now I was able to trade profitably using these concepts alone for years, but when I started implementing volume, everything changed. So I'm going to briefly run through each concept individually and then bring them all together into one clear, repeatable, rule-based system that you can apply on a daily basis. The first concept we're going to look at is market structure. Now, market structure is simply a tool I use to gauge the direction of a trending market. Because before we even start to look for trade entries, we need to understand what direction the market is likely headed. And we do this by using highs and lows. So in an uptrend, we'll be looking for higher highs and higher lows, right? So a higher high on the chart is simply a point that is higher than the previous high, and a higher low on a chart is simply a point that is higher than the previous low. And if the market continues making higher highs and higher lows, then we know that the market is in an uptrend. Then I also use a tool called a break of structure, or BOS. So a break of structure is simply when the market prints a new high or a new low. Okay, so because we are in an uptrend, we are seeing higher highs and higher lows. So a break of structure would simply be when price breaks into a new higher high. So this would be our break of structure. And then again, at this point, price breaks into a new higher high, which creates another break of structure. Now that we have our break of structure marked on the chart, we can get rid of our highs and lows. Okay, because we want our chart to be clean, we don't want it to be cluttered with a bunch of abbreviations. So we can go ahead and remove our highs and lows and left with something like this. So now we can clearly see by using our break of structure tool that the market is in an uptrend. So since we know the market is in an uptrend, making higher highs and higher lows, we want to be buying, right? So we want to be trading with the trend. And since the market is moving higher, we want to be buying in the same direction as what the market is moving. And how do we actually go about entering a trade once we have mapped out our market structure? Well, we do this by using supply and demand. Now, supply and demand is the next concept in my system. And the way I view supply and demand zones is simple. Okay, so they are seen as a good level to buy and sell from. Now, what does that mean? Well, since we know if the banks are wanting to put on a large buy position, then they need a bunch of retail traders to sell to them, right? So a demand zone is simply a consolidation area where the banks position their long orders before a drive up, right? So this drive up leaves a demand zone, okay, which is usually at the base of the move, and it is a consolidation candle or a range right before this drive up. Now, what a demand zone represents is this is a good level to buy from, okay, because previously at this level, we can clearly see the move or the drive away from here had a high momentum move away, taking price higher. Therefore, since this was a good level to buy from in the past, we can assume if price were able to pull back to our demand zone, retest it, then it can be seen as a good level to buy from in the future. So we can buy from demand. Now a supply zone is exactly the same, just in the opposite. So if the banks are looking to put on a large sell position, they need a bunch of retail traders to buy, okay? So they do this by consolidating. So a supply zone simply forms before a consolidation and then a large drive down, right? And this leaves a supply zone at the base of the move. Now, again, a supply zone was seen as a good level to sell your position, okay? So therefore, we can assume if price can pull back to the supply zone, retest it, then because this was a good level to sell from in the past, we can assume it's a good level to sell from in the future. So we can also look to sell from a supply zone. And that's all there is to it, okay? So demand zones we're looking to buy, and supply zones we are looking to sell. Now in the real-time markets, a demand and supply zone would look something like this in my system, right? So a demand zone is simply the zone that was left behind after a drive to the upside. Now, how do I mark on a demand zone? Well, I like to use the last candle, which is this one right here, before the push away. So this was the last candle, the last point of consolidation before this large drive up, right? So this would be our demand zone. And the supply zone is just the opposite. So it is the last candle before the large drive down. This was seen as the last consolidating candle before the bank stepped in and pushed price lower. And the logic here is the same, okay? So if price were to pull back, retest our demand zone, because this was seen as a good level to buy from in the past, we can assume it will be a good level to buy from in the future. And the supply zone is the same. Because this was seen as a good level to sell from in the past, if price were to return to it, then we can assume this is a good level to sell from in the future. Now that we have an understanding of supply and demand, we can go ahead and add it to our system. Now, one thing to note on supply and demand, that if you were to go and open a chart on a random piece of price action, then you would likely see supply and demand zones everywhere. Now, if you were to looking to buy and sell from every single supply and demand zone, then you would not do very well, okay? So, supply and demand has to be read in the context of market structure, right? So since in this example, price is in an uptrend, okay, we clearly see this because it is making higher highs and higher lows. And we covered when price is in an uptrend, we are looking to buy. So what would we be doing? We'd be looking to buy from a demand zone, okay? So we should not be looking to sell from supply in this case because the market is making higher highs and higher lows. Therefore, if we were to sell, then we would likely be taken out. So since we are in this uptrend and we know we're looking to buy from demand, what can we anticipate? Well, we should be expecting price to then pull back, right? We could look for a demand zone in these lows. Price will retest the demand and then likely go and push up and make a new higher high, because we are overall in this uptrend, okay, making higher highs and higher lows. So we want to be buying from demand zones. But it is not just any supply and demand zone we want to look to buy and sell from. It is imbalanced supply and demand zones. So what is imbalance? Well, imbalance is simply a gap in price. So if we were to look at this chart, we can clearly see we have our demand zone, which is this last candle before this drive up. And this, in fact, left open an imbalance. So imbalance is simply just a gap in this wick right here, and then this wick right here. So we can see these two wicks don't touch, right? So there is imbalance leading into this demand zone. And how do I trade imbalances? Well, I put a lot of weight on imbalances being filled. So since we have this imbalance here, which is simply just this gap in price, okay, we can see the wick of this candle does not meet the wick of this candle. So this is an imbalance price range. Now, how I trade it is I expect or anticipate that imbalances are filled. So if price pushes away like this, we have our demand zone in the lows, which has imbalance leading into it, then it is highly likely that price is going to return to fill this imbalance, retest our demand zone, and then continue higher from there. Now let's say, instead of leaving this imbalance open like this, let's say this wick actually pushed down to this point right here. Now this price range here is not imbalanced. However, we can see that this wick and the lower wick still do not touch. So our imbalance has actually shifted to this point down here. Now this may seem like a small imbalance, right? So this is a small imbalance over here. However, I still put a lot of weight on an imbalance, okay? No matter the size, even small imbalances are likely going to be filled. So in this case, I still think it's high probability that price is going to trade lower and fill this imbalance at some point, okay? And then if we retest our demand zone, we could look for buys, right? Now, let's say this wick in fact did push through and retest the demand. So in this case, there is no more imbalance, right? We can see this wick over here and this wick over here actually meet, okay? So the imbalance has been filled. There is no imbalance. What do I call this? Well, it's called efficient price action. Why is it efficient? Because price retested this demand, filling the imbalance, okay? So how would I go about trading this? Well, in my system, since this market or this price is efficient, therefore I would no longer be looking to buy from this demand zone, okay? So that means if price were to trade lower and retest our demand zone, then I would not be anticipating buys from here, okay? Because price already retested it at this point and filled all the imbalance. So if price were to trade lower and retest this demand zone again, then it is more likely that price is going to go lower, whether that being targeting another imbalance area or actually just completely reversing. So imbalance adds a further layer of probability to our setups, okay, because we are looking for the highest probability zones to buy and sell from. That means I'm only taking trades from imbalanced demand zones. Okay, so I'm only looking to buy from imbalanced demand zones, and I'm only looking to sell from imbalanced supply zones. Building onto our system, we know that these demand zones must have imbalance leading into them. Now let's say instead of price going and printing a new higher low and higher high, it instead goes and prints a lower low, right? So now the sequence of higher highs and higher lows have been broken down. So this is the first sign that the trend is shifting. And we see that clearly when price breaks structure to the downside, printing a lower low. So in this case, we would stop looking for buys because the trend has potentially shifted. And we would instead look for a supply zone. And the supply zone must have imbalance leading into it. And then what we would do is simply look for a sell position from there, right? Because we know when we are in an uptrend, we are looking to buy from imbalanced demand zones. And when we shift from an uptrend into a downtrend, then we'll be looking to sell from imbalanced supply zones. The next piece of the system is liquidity. Now, all liquidity really is orders, okay? And the three types of liquidity I use are equal highs and equal lows, swing high and swing low, and trend line liquidity. Now, in this example, I'm only going to cover equal highs and equal lows, but all liquidity can be seen in the same way, okay? It's just the form is just different, but the way we trade it is exactly the same, right? So equal highs and equal lows. Well, in the general retail methodology, retail trader methodology of how you approach markets, typically uses support and resistance. So what does that mean? Well, basically when they see a 3 touches like this, they call it a support floor. And when they see 3 touches like this, it is called a resistance, okay? And the idea is that every time price retests these levels, they are looking to buy or sell, right? So at this point, once price retests this point for a 3rd time, retail traders will be looking to buy this market, and then we're looking to target the resistance level. Then you also get breakout traders, right? Who would in fact wait for the support floor to break, and then they would be selling, once the support breaks with their stops above the high. So we have retail traders trying to buy the support, and then when the support breaks, we have the breakout traders trying to catch the reversal. Now, why do the big banks exploit this so much? Well, because there are a bunch of orders sitting beneath this level, right? In the form of stop losses and sell stops, okay? So we covered that if the banks are looking to put a massive buy position on, then they would need a large number of retail sellers to sell into them, okay? Therefore, these stop losses are just sell orders, okay? So if a retail trader is buying the market at this level, then their stop loss is simply a position to sell their contracts back at a lower price, right? And same goes for these breakout traders. So they are looking to sell into this market. And what does that allow the banks to do? Well, it allows them to buy into all these sell positions over here. So it would look something like this, where we have this pool of liquidity, which is sitting below these equal lows. And what the banks typically like to do is they drive price through the lows, collecting all these sell orders, and then take price the other way. Now, oftentimes you will see what happens is you'll find a demand zone which sits beneath these equal lows. Therefore, what often happens is the banks drive the price through the equal lows, collecting all the liquidity here, trade in towards a imbalanced demand zone, and then take price the other way. Now, the same then happens for the reverse. So a resistance, traders will be looking to sell from this resistance. So when price comes and retests this resistance level, they'll be looking to sell the market and take it the opposite way. Now, in the same way we had breakout traders for support, we have the breakout traders for resistance. So these are the traders who are waiting for price to break the resistance level, and then they'll be looking to buy and take the market higher. Now, in the same way we had these stop losses above here, we have stop losses sitting below here. We have stop losses sitting above here. So these are stop losses, and then these would be buy stops, right? Because if a trader, so retail trader, is looking to sell from this level here, then their stop loss is simply an order to buy their contracts back at a higher price, right? And over here, the same applies. So breakout traders are looking to buy the market at this level. So there are a bunch of buy orders sitting above this level. And what does it allow the banks to do? Well, if there are a lot of buy orders, that means they are able to sell into these positions, putting on their large sell order. So what typically happens is that the banks will then drive price through these equal highs, collecting all this liquidity that's sitting above, and then take price the other way. Now, in the same way we covered the demand zone on this side, we have a supply zone on the top. So what typically happens is the banks will drive price through the equal highs and trade toward a imbalance supply zone, retest the supply zone, and then take price the other way. And this is the typical characteristics of a range. So when we look at a range, it'll look like this when price is bouncing between the same high and same low, okay, forming a range. And as we know, there is liquidity on either side of the range. So there will be stop losses and buy stops on this side, and a bunch of stop losses and sell stops on this side, right? And we know the banks like to target this in order to fill their large positions. So what typically happens when price forms a range is that we'll sweep the low of the range, and then you'll see a large drive to the upside, which would then sweep the high of the range, and then sometimes we'll see again a large down to the to the downside. And this is simply the banks using the liquidity to fill their large positions. So how do we go about trading this? Well, when we see liquidity form like this, we know that it's likely going to be swept, right? So what we can do is we can use this as a target. So when we see liquidity like this, we know we have a clear target which would take us towards these equal highs or equal lows. Or we can use it for entries, right? So we know after price sweeps a liquidity area, so let's say price sweeps these equal lows, we know it's likely that it may see a reversal from there, okay? Because we drive through the lows, we collect all that liquidity, the banks are able to buy into all that selling pressure, all these selling orders, absorb them, and then take price the other way, okay, to target the high of the range, right? So this is how we can use liquidity to as targets as well as high probability entry points. So let's bring liquidity back into our system. Now, we know price is in an uptrend. However, let's say instead of pulling back and retesting our imbalanced demand zone, price in fact went and formed two equal low points, right? Now, these two equal lows sit perfectly above a imbalanced demand zone. Now, as we know that the market likes to fill imbalances, they also like to take out liquidity, right? So right here, we can see we have the equal lows, plus we have an imbalanced demand zone. Therefore, it's likely that the market is going to trade lower, sweep the liquidity, trade towards the demand zone, fill the imbalance, and then continue higher. And this is something I see time and time again in the markets, right? So when we are trading this supply and demand approach, we can simply look for an imbalanced supply or demand zone. And if this imbalanced supply and demand zone has liquidity sitting above it, then it's likely that that is going to be filled, okay? Price has a tendency to trade towards liquidity, sweep liquidity, target the imbalanced supply and demand, and then continue trending in the direction. Now onto our last concept before we put everything together into one system. Now the last one is volume. And this one will be an eye-opener for many traders. Now, like I said, I traded for years using, the concepts we covered before, like supply and demand, market structure, imbalance, and liquidity. And I was profitable, okay? But when I added volume into my trading, I gained another level of confidence that I cannot trade without anymore, okay? So volume is a extremely powerful tool that I use in my system in order to give me that additional confluence in my trading setups. Now, when you think about volume, what does this mean? Well, volume is simply orders, right? It's the activity, the amount of activity that is being happening at a particular price level. So if we think about this orders and activity and volume, who is actually responsible for this volume? Okay, so if we see a high volume bar on the chart, who is actually behind it? And as we covered, we know the big banks control price, right? So the big banks are trying to put on these large positions. And when they do, shows up in the volume charts, right? Because they are the only ones who have that capacity to place such a large position or a order that will show up on the chart. Now, if we think about it, okay, what do the banks like to do? Well, they like to operate off a simple principle, and that is buy low and sell high. Yes, that might sound simple, but let's think about it for a second. So what does that mean if they want to buy low? Well, as we covered, for the banks to buy, let's say they want to buy a $100 million position, then they need retail traders to take that other side of the trade. They need the retail traders to sell into them so they can buy into that, right? Now, if the big banks were to simply hit buy, that would shoot price up. Okay, that would shoot price up, and then they would not be able to put on their full position before price actually takes off and starts trending. Okay, so they'll get a bad entry overall. However, if the retail traders are selling and the banks are buying into that selling pressure, they are essentially absorbing those selling orders and are able to put on a very large position at a low price without pushing price higher. Then eventually, when all those selling orders are no longer there, that is when the banks take price higher. Okay, so they are buying into the down moves, right? And the same for the selling side. Okay, if the big banks want to sell, they have to put a large amount of selling orders on, then they need the retail traders to be buying into them. Because again, if they were just to sell at a level with a large order, that would drive price down. And therefore the banks would not be able to get their full position on before price is already moving lower. So what they do is they sell into the retail traders who are buying, right? So by doing this, they are absorbing all the buying orders from the retail traders, and they are selling into that, putting their large position on, and that then will then drive the market lower. Right, now before we actually get into the chart and take a closer look at how we use volume, we need to have a basic understanding of market phases. Now, the markets move in four different phases essentially. We have accumulation, which then leads into markup, and then we have distribution, which then leads into markdown. Now, all accumulation is after a downtrend, so price has been trending down at this point, we then hit a phase of accumulation. Okay, so this is when price starts to range. And what this essentially is the banks are buying into these the selling move. Okay, so at this point, the retail traders are essentially still selling, right? Because they are selling this downtrend, thinking that the trend is going to continue, right? But what the banks then do is they start buying into this down move and start putting on their large positions. Now they do this in a range because, like we said, if they just hit buy, then price will start moving up, and they don't want to take price higher until they have their full position on. Okay, so they do this in a range. Now, when we look at the volume in a minute, what we essentially want to see is high volume at the lower prices, right? Because how I use it is lower prices tells us about buyers, right? And higher prices tells us about sellers. So these lower prices, typically we'd like to see the high volume bars there, because that's telling us that as price moves lower, the banks are stepping in, okay? Because if we see a large volume bar, that means there is a lot of activity, a lot of orders being placed at that level. Therefore, it is telling me that the banks are stepping in at this level and they are buying into these down moves, right? Then what typically happens after this range forms is that we get a sweep. So we sweep the range, again, like we said, taking all the liquidity sitting below it. And again, when we see this sweep, we like to see high volume at these lower prices, okay? So we see this high volume bar, which tells us that the banks are again buying at these lower prices, okay? Because there's a lot of activity, there are a lot of orders being placed at these lower prices. Now, one thing to note is that we can't simply just look at volume. We have to use what we covered in market structure, okay? So we pair volume with price action. So what confirms that this is in fact the banks buying? So if we do see the high volume bars down in these lows, what confirms this? Well, after price actually prints a new high, we break structure. So price then breaks structure above this level, okay, which we covered, is a sign that price is likely going to move higher. And then again, we look at the volume at these higher prices. And what we want to see now, well, if lower prices are telling us about buyers, that means higher prices are telling us about sellers. So for this to lead into markup, which is a continued uptrend, we essentially want to see lower volume at these highs, right? Because we are seeing the banks accumulate at these lower prices, right? We see the last drive down, sweep in the range, collecting the liquidity. We see the high volume in these lows, and then followed by a break of structure to the upside. Now we want to see that the sellers are not stepping in at these higher prices, okay? So we want to see lower volume over here, which then tells us that the banks or the buyers are in control, okay? The banks are buying, and then what follows is this pullback retest of demand. So this is where essentially we're looking to buy and then this takes price into new highs, okay? And then the same is in reverse. So distribution is what happens after a extended up move. So after price has been trending higher, then when the banks are looking to put on all their short positions, they would look something like this, right? So after an up move, pricing starts to range. And again, this is just the bank stepping in and selling into this buying pressure, right? So they're able to put on their large short positions by selling into these retail traders who are essentially still trying to buy, and they can put on a large position in a range, so they get the best price possible for their position. Because again, if they were just simply to sell with a massive position, price would simply just trade lower, and they wouldn't be able to get in their full position, okay, without price moving substantially lower. So they want to try and get as much of their position on in a range so that they can get the best possible price for it. Now again, in the same way we assess, the accumulation phase, how we assess distribution using volume is we want to see the volume at the higher prices. Okay, so as price trades higher, like we said, higher prices tell us about sellers. We want to see the high volume, right? Now again, price then sweeps the range, and again we want to see the high volume stepping in here, because higher prices tell us about sellers. So if we see high volume over here, that's telling us that there are a lot of orders. There's a lot of activity that's happening over here, okay? So this could potentially be the banks stepping in and selling into these buy orders. Now, as we covered, this does not mean that we can immediately sell here, okay? So if we get the high volume at these highs, this does not mean we can just blindly sell into this. What do we need? We pair volume with structure. So after we get the break of structure to the downside, we again like to assess volume at this point, okay? Because higher prices tell us about sellers. So we get the high volume here. We see the banks are stepping in and selling. We get the break of structure, but now we need to make sure that the buyers aren't stepping back in at this point, okay? So we need to see lower volume at this point, okay? We need to see these lower prices being accepted, and therefore telling us the sellers have now taken over, okay? Because we had this up move into a distribution, high volume in the highs, lower volume with the breaker structure, and that tells us we can happily look for sells to take price lower. So before we head to the charts and start putting this system together, let's take a quick look at how or what we actually want to see when we use this volume bar. So as we said, we want to see buying at lower prices, okay? So the banks are buying into the down moves, right? So this is typically what we want to see. We want to see the peak high volume bars right in the lows, okay? So as price is moving lower, we want to see these high volume bars, which tells us that the banks are stepping in at these lower prices, okay? And following this, we'd like to see a break of structure, and then that tells us, okay, we can take the market higher. Now again, if you take a look, what can we see at the highs? Well, if we look at the higher prices, the volume is very low, okay? So again, at these higher prices, we see the volume is low, which tells us that the sellers are losing momentum, okay? So if we take a look at the right here, if we are looking at a selling move, so if the banks are positioning for a selling move, this will typically follow an uptrend. Now, again, we'd like to see the high volume at the higher prices. So we see the higher prices here, and we see the high activity, the high volume. The banks are stepping in and starting to distribute, okay? Again, we see the high volume at the higher prices, and again, the high volume at the higher prices, which would then need a breaker structure and would get us into a short position. Now, again, at the lower prices, we like to see the lower volume, okay? So the low volume here, and again, the low volume here, which says the buyers are losing steam and the sellers are taking over. And that is all there is to it. Now, I don't want to confuse you with this volume tool, okay? And we mustn't forget about our other concepts that we covered, like supply and demand, market structure, imbalance, liquidity. Those still play a very, very important role. Volume is just the additional layer on top of that, okay? We are not simply using volume to trade, okay? Volume alone is not good. Same as market structure alone is not good. Supply and demand alone is not good. But when you put all these concepts together, it builds a high probability system, which we can then use to find high probability setups. Now let's take everything we have learned and put it into one system that we can execute on a daily basis. Now, what I like to do is start with market structure, okay? And for this example, we are going to leave off the volume for now, okay? Because I want to show you that these concepts work by themselves, and then we'll bring in volume at the next example to show you how to add that additional layer of confluence to your system. So starting with market structure, if we were to take a look at this trend, we can see we have this higher high, higher low, higher high, higher low, higher high, higher low, higher high. Now, after marking our highs and lows on, we can see at this point, pricing goes and prints a lower low. Okay, so we broke through this higher low, printing a new lower low, like this. Now, if we were to take our break of structure tool and mark on the breaks of structure, it would look something like this. And if we got rid of our highs and lows to clean up our chart, then we would be left with this. Now, we can clearly see, just by using this break of structure tool, which way the market is trending and which way we should trade it. Now, you may be asking me why I did not mark certain points on its breaks of structure. For example, this right here. Why is this not a break of structure, or why are these not breaks of structure? Now, that is just simply the way I view structure. So I like to view structure in waves, right? So we're looking at the most clear points on a chart, which create the highs and lows. And then what we do, so in this case, once we have our higher high, right, and our higher low, which would be this point, okay, in this leg up, then all I do is simply wait for price to either break out into a new higher high or break lower into a new lower low, okay? So any structure or any price actions that happens between a high and a low is just consolidation, okay? It's just a range, and I don't read too much into the structure within this trend, okay? This is something called substructure, and I'm not going to get into that right now. However, I simply mark the most clear points on the chart, and I view it in waves, okay? So the larger waves, which tells me the trending direction, instead of looking at every minor structure break, which is simply just noise, okay? So we don't want to look at every structure break, because a structure break, for example, at this point, does not mean that the trend is ready to shift, okay? Because we see this as our drive up. Therefore, we need a break then below this point in order to confirm a full trend shift, right? So these smaller breaks are lower time frame breaks, and we don't want to read too much into this when we are assessing the larger trending direction. So at this point, we can clearly see the market was trending up, okay, making higher highs and higher lows. And then we had a break beneath this low, right? Creating a lower low. So now this is our first sign that this uptrend has potentially shifted into a downtrend. So our idea would be we could look for selling opportunities to take price lower. Now, if we start bringing in the other concepts which we like to trade, like supply and demand zones, imbalance, liquidity, etc., we can see that we have a clear demand zone right here, right? This last candle before this large push up. And this demand zone has imbalance leading into it, okay? Now, as we know, we like to buy and sell from imbalance supply and demand. And we also like to put a weight on imbalance being filled, okay? So when we see an imbalance like this, it's likely going to be filled at some point. Now, that does not mean we are simply going to sell into this market, hoping that we catch the sell down to fill the imbalance. No, we need to wait for the market to give us reason to actually target this imbalance, right? And it has done so by creating a break of structure to the downside. Now, after we had this break of structure to the downside, what can we see? Price traded in an efficient range, okay? So if we take a look at this range over here, there is no imbalance, right? And as we know, the high probability setups come from the imbalance supply and demand zones. And since there is no imbalance in this price range over here, it is unlikely to produce a meaningful reaction, okay? So at this point, I would not be anticipating that price is going to fully reverse and create, or fully, go ahead and create a new high from this point right here, okay? Because we are trading in an efficient range. Therefore, it's more likely that price will pull lower, trade towards an imbalanced demand zone, and then continue higher from there. So that is, we are starting to build our story around this setup and what the market is likely going to do. Now, if we bring liquidity into this, we can see we also formed two very equal lows. Okay, so we see these equal lows right here, 1, 2, and as we know, this acts as liquidity. So it is likely that the market is going to sweep this at some point. Okay. Now, we have pretty much formed our idea. Okay, so the market was trending higher, then flipped, had a break of structure to the downside, opening the doors to this imbalance right here. Okay, and we also created two equal lows. So at a minimum, we can use these equal lows as a target, because we know that they're likely going to be swept at some point. And since the market has shown willingness to trade lower by this breaker structure, we can use this to catch a trade to the downside. Now, where would we be looking to sell from? Well, again, if we like to target imbalanced supply and demand zones, we also like to sell from imbalanced supply and demand zones. So we can clearly see price has formed this supply over here. Okay, and the supply had imbalanced into it, but then it pushed back, retested it, and then sold off. So this may have been a good trade initially, but now price is coming back to retest this demand zone for a second, and even third time. Okay, so we can see prices pushing back into the supply zone 1, 2, 3 times, right? So this supply zone has become weak. We are not looking to sell from this supply anymore. But where would we be looking to sell? Well, we'd be looking to sell from an imbalanced supply zone. If we look higher up, we can see we have this supply zone, and this supply zone has imbalance leading into it right here. So we know this is a high probability area to sell from. If we also take a closer look, we can see we have also formed 3 relative equal highs. Okay, so we have liquidity sitting above this level as well. Now, we have liquidity sitting above. We have liquidity sitting below. So we know it's likely the market is going to take these points out. We have this imbalanced demand zone sitting below, and we have this imbalanced supply zone sitting above, which we know also is likely to produce reactions. We have the break of structure. So price was initially making higher highs and higher lows. It then flipped on us, breaking through this low, trading into an efficient range. So therefore, there's no reason we should be expecting price to continue higher from here, right? Formed these 2 equal lows, which are likely to be swept at some point, and also left open this imbalanced supply zone, again with liquidity sitting above. So this is a high probability setup, which we formed by putting all these concepts we learned together into one simple system. And what can we do from here? Well, we can simply place a sell limit on this supply zone, stops above the high, and our targets, well, essentially we could look to target this imbalanced supply demand zone for 8.6 or 8.7%, which is a huge position. Or we can simply go for the safe option, which is targeting these equal lows, because it could still be possible if price does trade lower, sweep these lows, then as we know, once price sweeps equal lows, it may produce a reaction. Okay, so even though we are expecting this imbalance to be filled, it is not always guaranteed. Okay, we say we trade probabilities, so it's not always guaranteed that it is going to be filled. So a more conservative target or a high probability target will be these equal lows. Okay, it is very likely these equal lows are going to go, and this is still a 5.8 R position. Okay, so a 5.8% position, which is still a very big trade. And if we were to let the market play out, then we can see we get the tap in and a clear run to our target. And that is all there is to it, okay? Simply by stacking these concepts that we learned on top of each other to build a story, okay? We are forming a story, seeing what the market is telling us, where it is likely to go, and from that we can find our high probability trade entries. Let's look at another example, but this time bringing volume into it, okay? So we're still going to use the same concepts, the same system. We're just going to add that layer of volume onto this, okay? So again, starting with market structure, the first thing I always do is look at market structure, right? Because that gives us our initial, background or overall bias. So we can clearly see this market is in a downtrend. If we were to map out the market structure, we can see price is made lower low, lower high, lower low, lower high, lower low, lower high, lower low. And if we were to use our break of structure tool, then it would look like this. So clearly we can see price is in a downtrend. And since price is in a downtrend, what would we be looking to do? We'd be looking to sell from supply. Now we can see we have a clear imbalance supply zone right over here. So you may be thinking it is a good idea to place a sell limit on this imbalance supply, stops above the high, and our target would be the low or another, target down lower. However, this is not a good trade to take. Why? Okay, you may be thinking the market structure is in our favor. We have this imbalance supply zone. It's clear that price is trending down, so this is a good trade. However, if we use volume, then we can clearly see that this is not a good trade to be taking. So let's actually go and break down what volume is telling us. Now, as we covered, we like to see high volume at lower prices, which tell us about buyers, and higher prices tell us about sellers. So if we were to look at this downtrend, okay, we can see prices trending down, and we can also see where our high volume bars are. Okay, so if we look at these two high volume bars, they are right over here, and our next two high volume bars are, a high volume bar is right over here. Now, this is a good example to cover this. Okay, so volume, we use it in any other way as we use any of the other concepts. Okay, it's all based on probability. Don't think that these volume bars are going to tell you exactly, when to trade. Like this is not the holy grail. Okay, the volume is not a holy grail, but it is a additional layer of confluence like any other concept we use in this system. So these two high volume bars are not telling us much, right? Where do we actually assess volume? So we like to assess volume at specific areas. So when we're in a downtrend, we want to assess the health of a trend. Now, how do we assess the health of a trend? Well, because price is trending down, we know we like to look at lower prices, okay? Because lower prices tell us about buyers. So what we essentially want to do is in this downtrend, we want to see if the buyers are stepping in and buying into these lower prices, okay? And if they are not, then it is safe to trade. So let's start over here. We can see at these lower prices, when price breaks into this low, what do we see? It's low volume, okay? These two high volume bars are actually as price is moving higher. So these two volume bars could tell us that these sellers are in fact stepping in at this price, pushing the market lower. Now, what do we see when price breaks into new lows? Okay, so we are assessing volume at specific points. Okay, so when price breaks into new lower prices, that's when we look at the volume. Okay, and as we can see, when price breaks into these new lower prices, what can we see by the volume? It's pretty low. Okay, compared to what we're seeing across the board, this is quite low volume. Therefore, it's telling us that the buyers are not stepping in at this point. Okay, so we can happily still look to trade this market lower, right? Now again, our next high volume bar is kind of mid-trend here, okay? But we don't read too much into that. We're not trying to decipher every single volume bar thinking it's going to give us information, okay? We simply use specific price levels paired with volume, paired with market structure to give us an overall picture, okay? We're not trying to read into every volume bar. So this volume bar is not telling us anything, right? However, we can see pricing breaks lower, and what can we see in the volume? Well, this volume is again quite low, okay? It's relatively low at this point. Therefore, it's not telling us to hold on selling. It's actually telling us that we can happily continue looking to sell this market down. Now, at this point, price then breaks lower. Okay, so we have this breaker structure. Now what do we see? We see high volume, okay? And look where this high volume is. It's right in these lower prices. And what followed this high volume? Well, it wasn't a push lower. It was in fact a range, okay? So we had a consolidation. So remember our accumulation schematic. So after price is in a downtrend, we get hit high volume, okay? So this is stopping volume right here. And then price starts to range, okay? This is where the banks start to accumulate their long positions, right? And we see that by this high volume bar here. Now, what happens after this? Price then pushes lower, so breaks through this level, pushes lower, and what can we see? High volume, right? So again, like we know with our accumulation, we form a range, accumulation, price then sweeps the range and then pushes back to the upside, okay? So we are seeing buying at these lower prices, right? Now again, price then consolidates for some time, pulls back, and again, what do we see? The high volume in the lows. Okay, so again, this is telling us that the banks could possibly be stepping in and buying at this point. Therefore, this sell trade was not something we'd want to be taking, okay, because clearly the banks are putting on large orders at these lower prices, okay, evident by these high volume bars in the lows. Now, in order to confirm this, we need a break of structure, right? So where would our break of structure be? Well, it would be this point, okay, because this is our last lower high. So we'd essentially need this to break in order for price to confirm that, you know, this is in fact high volume buying. Okay, so if we get this break, then we can look for pullback and long positions. And if we let price play out, we can clearly see we get the break of structure. Now what do? We pair volume with the break of structure, okay? So we can clearly see we have the high volume at the lower prices, right here. And what happens when price breaks into new higher prices? Well, higher prices tell us about sellers. And look at the volume. The volume is very low, okay? Look at this low volume as price breaks into new higher prices. It is very low compared to, you know, these volume bars, okay? So we have to look at it relatively to what we are seeing across the board. So compared to these three high volume bars, this is low volume, right? So we can happily say that this was a phase of accumulation, and now we had the break of structure, so it's likely price is going to trade higher. So what can we do? Well, we can mark on an imbalanced demand zone. Now we do have a few imbalanced demand zones in this trend. However, we can simply go for the last imbalanced demand zone, which I typically like to do, and we can look to, you know, target whatever we're looking to target. Now, in this case, we can clearly see that we actually don't get the pullback. However, that is fine, right? So we missed this entry, but it is okay, because we don't have to always get in at these lower prices. We can join in at a later time, right? Because we know this trend has now flipped, okay? So we flipped from a downtrend into a healthy uptrend, evident by price action, firstly, and by the volume, telling us that the banks were in fact accumulating at these lower prices, looking to take price higher. So how would we get in at a later position using, again, structure as well as volume? Well, if we take a look right here, what can we see? These higher prices, so as price pushes into new highs, what can we see by the volume? Look how low this volume is, okay? Low volume at these higher prices. Now, what happens when price actually dips lower? So lower prices tell us about buyers. So this is actually the banks stepping in again and buying at these lower prices, right? So this area over here, you can see the volume. Look how much orders were placed. Look how much activity was going on at these lower prices. Now, in order to confirm that this is in fact buying, we need to see higher prices on lower volume. And what happens? Price breaks structure into new highs, and clearly we can look at the volume and look how low the volume is. Okay, look how the volume dropped off. So after we had this high volume, okay, which price when price pulled back, we had this high volume, and then higher prices, we saw this drop off in volume. So it's low volume. So there's not selling. The sellers aren't stepping in at this point trying to push price lower. Okay, it's in fact the buyers who are in full control buying at these lower prices. So what can we do? We can simply mark on a imbalanced demand zone, which is this one right here. Now we do have two imbalanced demand zones, so we could mark this on as well. So we have these two imbalanced demand zones. Now we can look to buy from the higher zone, okay? But just make sure that our stop loss covers the low, just in case price does, wick through and retest this lower zone before trading higher. And then our targets, we can look to extend our targets. So if we play price out, we can see we get the retest, and then price eventually takes off in our trending direction. So just to show you how powerful this volume tool is, using it with the rest of our system. So here we got our entry and we can see how nice this trend was, right? We caught this massive trend up. Now, at what point do we, start looking to get out? Well, we can use the volume as well. So where do we see our next high volume bar? We see it right here. Okay, so these two high volume bars over here, we have this one here, and then this one is also high compared to what we have seen relatively. And what does this tell us? Well, as we covered, higher prices tell us about sellers. And where do we see this high volume bar? Right into these highs. So as price is moving higher, we see these massive volume bar, okay, followed by a push down. Okay, so this is telling us that this is potentially sellers stepping in. Okay, so there's a potential that this trend could be reversing. And what can we see? Well, the start of a down move. Okay, so after this high volume come in, we saw price actually started trending down. And that is the complete MacFx trading system. From the big banks all the way through to how you apply the full system in the live markets. Everything I covered today, market structure, supply and demand, imbalance, liquidity, and volume, is covered in full detail inside the MacFx Academy. Each concept has its own dedicated lesson with specific rules, in-depth chart examples, and everything you need to go from understanding the concept to actually executing it with confidence. The course is 5 modules, designed to build one clear, rule-based, repeatable system from the ground up. It takes you through everything you need to know to become a consistently profitable trader in a simple, structured way that you can apply in the live markets. And the course is just the starting point. Once you have completed it, you get access to the network, which is a private trading community built exclusively for traders who have put in the work. Inside, you get my daily and weekly market analysis, extra lessons, Q&A sessions, and direct access to me. You are not buying a course and figuring it out alone. You are joining a community of serious traders who are applying the system in the live markets every single day. The link to the MacFx Academy is in the description below. If you are serious about building a system you can genuinely trust and scaling it through the prop firms, that is where you go next. If you're not quite ready yet, the free Telegram channel is also linked in the description. Join there and you'll get ongoing market analysis and content while you make your decision. And if you found this video valuable, please like and subscribe, and I'll be releasing regular videos covering each of these concepts in depth, like market structure, supply and demand, imbalance, liquidity, and volume. So you do not want to miss that. Thank you for watching, and I will see you in the next one.